Let's take a look at this brutal market. It's down another 2% as I'm recording this. NASDAQ is now down 15% from highs. What is this, a real correction for once? This really is like the first real correction we've had in 18 months? Where are my dip buyers at? We'll talk about that in a second. But what we want to figure out is what conditions do we need for a bottom to actually form? Because this has gone pretty much straight down. You don't often see this type of movement so fast, but there's a reason for it. So the reason is, and this is not surprising, but rising yields. That's the problem here. But what's even worse is how fast those yields are rising. And when we talk about yields, we mean interest rates. So we have fast rising yields in richly valued stocks because this market has gone straight up for so long, and that creates a dangerous cocktail as we've seen this past week and today. So the 10-year bonds impact, which is their level plus their rate of change, so their impact on equities is in the 100th percentile right now, which historically leads to low to negative forward equity returns. So to see a bottom, we need a few things. First, we need scared sentiment. We need people really scared that the market is going to keep collapsing. Because sentiment is what? It's like a contraindicator, right? If people are really scared, that's actually bullish for stocks. Second thing we need is a positioning washout. So all the people that were long need to be out of the market. So along with that, we want to see oversold technicals. So the AAII survey is hitting lows last seen during the COVID bear market bottom. So people are getting very bearish. You can see that right here. This is that red line. You see it's matching up with the previous COVID bottoms. And our indicator, the nervous and numb indicator, is nearing a major buy signal. Once again, this is our indicator right here. You can see it's heading lower to this green area where it becomes time to buy. That being said though, positioning, which is the other thing we want to see change, is still quite long. So people are still invested. And speculators are actually increasing their longs. They did that last week. And money flows and hedge fund positioning, they're still at incredibly stretched levels. So people haven't moved their money out of the market just yet, even though this thing is falling. But we need to see that in order for a bottom to happen. Now, if you look at the different sectors and their breadth, they are in deeply oversold territory, especially tech, real estate, and consumer discretionary stocks. So they're technically oversold, which is a good bullish sign because things eventually turn around. But just because they're oversold doesn't mean they can't become more oversold. So you got to watch that. That's also why we look at three things together versus just one. You got to look for a confluence of signals because you can't trust just any single signal. But the problem, as we talked about before, is that we have extremely rich US valuations. Like, look at this EV over EBITDA. It's just so high up there. Price to sales is all the way up there. So the reason this matters now is because when these things turn around, you can see how far they have to fall to even come to a regular valuation standpoint. Price to book is up there too. So there's a lot of room for these things to fall, and that's part of why tech has been hit so hard because they are the most overvalued. You got companies making no money at all and people are buying up their stock left and right. That all changes in a bearish market. And I'm not even saying we're in a bear market right now, but look at the correction that's happening. Now, tech in particular has been getting hit heavy for the last few months, so it's been a while. According to the latest Bank of America fund manager survey, fund managers haven't been this light in tech since December of 2008, which is crazy. So certain sectors like tech have kind of already been in a bear market, but again, they have a lot to fall. What's interesting is that the highest allocation of these fund managers were to cyclical stocks, which is strange because when growth is slowing, and this is total growth, that's typically not good for value or cyclical stocks. Now, despite volatility spiking and the rise in rates, and by the way, look at VIX today, new highs. We haven't seen this level since a year ago? Wow, almost exactly a year. That's crazy. But anyway, despite the rise involved, financial conditions remain near historic lows, meaning money is still loose. Now, price, which is the number one indicator you want to follow, it's always acting under the influence of two opposing forces at all times. First, trend and momentum, which is the larger trend like this. And second is the reversion to the mean. This is for any asset class. So markets trend and then they revert to the mean. So that being said, the Qs right now are trading 10% below their 50-day moving average. Like I said, you don't often see this straight down type of movement because when they are so far below their averages, they usually spring back up and touch them, right? They revert to the mean. This has not done so yet. And that means because it's so far below these moving averages, this marks a deeply oversold level. So we should expect to see some reversion back to the trend over the short term. Again, doesn't have to happen and it doesn't look like it is, but this market could bounce back up to this 200-day, which is this blue line, and then continue lower. That's what normal movement would look like. This is pretty steep fall though. One of the tools that we built, which is our summary predictor tool, it looks at historical combinations of price patterns to see a 10-week projection of average follow-on returns. What's interesting here is that the NASDAQ does not look good at all as far as forward returns in the next 10 weeks. It's saying in the next 10 weeks we'll be down another 8%. Now again, you don't want to look at this by itself, but you got to look at the rest of the context too. But one of our biggest indicators of what the market is going to do actually comes from our lead researcher, Alex at macro ops. And the way it works is whenever he's traveling, the market tends to collapse. And guess what he's been doing for the past week? Traveling to Alaska, literally driving from Texas to Alaska. He's been on the road forever. And that is why you've seen this market absolutely collapse. So really everything I said in this video doesn't matter. All we need is Alex to stop traveling and the market will recover. I think he's just moving into his new Alaskan place today. So we'll see if we get some recovery here. But so far, not so good. What, we're almost at 3% down? Man. And I'll tell you what, I'm actually excited for this correction. Because now, if this correction is real and it continues to go, and I'm so tired of the dip buyers, just throwing risk control out of the window, saying, no, the market only always goes up. And if you use our systems or our algorithms, we've been knocked out of the market last week. So when that happens, if the market keeps going lower, obviously your returns look much, much better. And this is where the buy and hold screws you. This is where the risk control really comes in handy. In our macro ops portfolio, we're almost all in cash. So our returns there look great too. So for all the people that have had a bad year due to risk management, because what happened for the past year, every time the market went down a little bit, it would rebound, right? That's where risk management looks bad, because you just get knocked out of your positions and then the market takes off without you and your returns look bad at the end of the year. But the reason you keep that risk control, even when it's tough, is for times like this, when the market keeps going down, when we have a 15% straight down move in the NASDAQ and it keeps falling. This is where you want your risk control. So that's where I'm like, yeah, selfishly, let the market keep falling. Let it correct a large amount, because then when it turns around, our systems are going to jump back in and ride it all the way up. And we will crush the market this year, if it plays out like that. But honestly, now that I've said this, and this video will come out on Tuesday like normal, the market will probably rebound, because that's how it works for me. I say one thing, the market does the other. But again, doesn't matter if you have the system or the algorithm working for you, because the risk control is always in place. And yeah, I'm just excited to see it pay off, because I'm all about controlling risk. So this is a good lesson that markets don't always go up, and buying the dip is not always a good strategy, especially if you don't have any risk control, because risk control is the number one thing you need in the market. But good luck out there, manage your risk, and you will be just fine. I will see you next week.